Hello and a very warm welcome to our esteemed panelists and our audience today on this session on the opportunities and challenges in digital lending. My name is 𝗟𝗶𝗴𝗶𝘁𝗶, and on behalf of 𝗟𝗵 and Resurgent India, it will be my privilege to be your host today. We are joined by an esteemed panel of members from digital banking and financial services industry, and it will be our honor to learn from their deep domain experience and their journeys from physical to digital banking and their experiences in working with the fintech industry in India. Before I invite the panelists to share their views, just a few highlights on the enormous growth of digital lending in India. Digital banking and fintech is increasingly becoming omnipresent today, right from wealth management to insurance to payments and lending. The market size is expected to grow from 2 lakh crores to almost 8 lakh crores by 2026. India has the third largest number of fintechs globally after China and US, and the highest adoption rate at 87% as compared to the global average of 64%. I think from the first phase of digitization in financial services, with the opening of the Jan Dhan accounts, to the second phase with the emergence of UPI, we are now in the third phase via the neobanks, the emergence of the account aggregator model, and the setting up of the digital banking units as proposed by the government. Rural internet is growing at the rate of 30% CAGR in the last 5 years, and we've reached net 336 million subscribers. The account aggregator model itself is growing 28% week on week. Yet, of course, the challenges are there. There is still a gap in credit access to MSMEs, which is still very, very significant. This is a sector that contributes 30% to our GDP, 45% of the industry output, and 40% of our exports, and generates almost 90% of jobs in India. And yet, the access to formal credit is still much, much lower. Our credit to GDP ratio is still only at about 55% as compared to 160% for China and 135% for emerging markets. I think another interesting area has been the emergence of BNPL. The existing BNPL market is about 3.5 billion in India today and is expected to grow 15x to about 45-50 billion by 2026. Banks themselves are making substantial progress on digital lending. Kotak via the 811 app, SBI via YONO, ICICI has only last month launched the InstaBiz app just for MSMEs. So these are huge steps that are being taken. RBI, of course, has come out with a very, very useful paper on digital lending, and so has 𝗖𝗵 𝗹𝗶𝗃. Of course, a new challenge has just emerged this week via the RBI circular, with some views calling it the nuclear winter for fintechs. The Reserve Bank of India has asked non-bank prepaid instrument issuers to not load their PPI instruments through credit lines. According to RBI, there are 35 non-bank PPIs, and this circular is likely to impact all those players. The regular perspective, of course, being concerns on anti-money laundering, slackened KYC norms, misreporting of credit-to-credit bureaus, and fintechs becoming lenders without any adequate standards and safeguards. So the idea is to reduce the systemic risk. But the flip side, of course, is the access to credit. And the idea is how can we balance the same? So there are several themes and several areas that we can cover in our webinar today. We have a very, very diverse panel of senior members of the industry and experiences ranging from banking, neobanking, and fintechs. So really looking forward to hearing their views today. First up, I'd like to invite Mr. Rajat Kumar. Mr. Rajat is the co-founder and CEO of Checkbook. Rajat drives the lending business and is responsible for devising the product strategy across the country. His role is instrumental in driving Checkbook's mission from becoming one of India's leading digital banking players in the near future. A solution evangelist, Rajat has more than 18 years of experience in banking and financial services industry. Prior to starting Checkbook, Rajat worked with renowned banks such as IndusInd and Standard Chartered Bank. Rajat, over to you.
Thank you, 𝗟𝗶𝗴𝗶. Thanks to 𝗟𝗵 and Resurgent India actually for inviting me on this panel, and warm hello to all my fellow speakers. Now, 𝗟𝗶𝗴𝗶, I think the topic here that we are addressing is the digital lending piece and challenges and opportunities. And I would kind of restrict my conversation or my talk mostly towards MSME segment, because that is a segment that we kind of addressing through our company Checkbook. And so my experience and my would be more relevant for that segment. So I will basically, like you really laid down the whole gamut or the ecosystem that is there, that, we have huge requirement of financing and funding. Lending has a huge opportunity. So that everybody on this panel and everybody understands that digital lending as such is a huge opportunity. Every lending for every fintech, at the end of the day, every fintech kind of pivots to lending as the main monetization, because again, everyone wants, what everybody sees is that once they've acquired a fair bit of customers on their platform, lending becomes the major requirement of the customers. And then obviously in terms of monetization, is the best revenue generator for them. So, I mean, coming to the segment, actually what 𝗟𝗶𝗴𝗶𝗶 has. So 𝗟𝗶𝗴𝗶𝗶𝗃 basically is kind of a neobank for small business owners. So our segment is small business owners. And what we've tried to, what I've seen in the small business owners segment is that the lending challenges are much more kind of enhanced in every aspect of the lending business, right? There is in terms of requirement, in terms of onboarding, in terms of underwriting, in terms of due diligence, collections, everything is kind of more and more tricky. And these are basically because of, I would say a couple of factors, right? One is obviously the digital financial literacy of the MSME segment is quite low, right? There is a kind of a very high cost to acquire and serve this segment of customers. Another issue main being that there is a lot of information asymmetry in this segment, because, like let's say, for example, business proofs for these customers, or employee or a proof of business for these customers is very, very segmented and very kind of is across the country itself. In different states, you'll have different kind of business proofs for this segment. So it's very difficult to kind of have a standardized model on kind of looking at these business proofs or authenticating these business proofs. And third, obviously, is the lack of collateral, right? So like SMEs or corporates, these MSME segment does not really have a collateral to kind of give or give a lien to. And hence that becomes, so basically the lending opportunity that in this segment is mostly around kind of either on invoice financing, or it's unsecured business loan or term loan, right? That's what basically these, then, what you can kind of the products that you can give to these customers. And that is where, digital lending, so that is where, so one is, what we found was this is a blue ocean, because in this segment, MSME segment, and by MSME or a small business owner, what I mean basically is a kirana guy, a retailer, a sole proprietorship with a turnover up to 40 lakhs, right? That is what we define as a small business owner. And so this segment actually, we saw it as a blue ocean, because this segment is usually not been serviced by the bank per se, right? None of the banks go for it. And even in the NBFC space, most of the NBFCs try to kind of are more than kind of were looking at the SME space. And, because the segment there was much easier to kind of finance, much easier way to underwrite and all, and, so that is again, by taking a little bit more risk on the segment, you could, the realization of the loan amount or the grains could be much bigger, right? And you can kind of also in a SME segment, you can ride onto the banking kind of a segment also, because the banks are giving loans to these customers, and hence they have a credit history, and based on that, you can kind of base your lending mechanism on and give them the loans. But in this segment, this all is lacking, and that's what we found as a big opportunity, right? I've laid down the challenges, but then we also found it as a big opportunity, right? And to lending segment, and slowly what has happened is that a lot of technology is kind of helping us to to solve for each of the challenges that I kind of laid down. And one being, like, let's say if I talk about high cost to acquire and serve, right? There itself, there is a lot of automation that is now possible to onboard these customers by having digital journeys, and they're having some kind of authentications happening at every step, use of OTPs and all. So that kind of has helped a lot kind of to automate the journey itself and automate the onboarding process, which kind of, again, which has led to a huge reduction in cost of acquiring this customer, right? The other is in terms of underwriting. Again, like I said, there is a lot of authentications possible now. So underwriting again becomes much easier for these customers in terms of OKYC, CKYC, business KYC, proposed. There are multiple vendors, technology vendors available in the market who kind of help in assessing and acquire and kind of authenticating these things for the for the customers. And hence the underwriting piece or the due diligence processes kind of become much easier for this segment. Another thing I could talk about is the use of digital financial services again has kind of become very easy through this mobile telephone devices that kind of now, which is kind of the revolution of which actually been brought down by UPI. So we all of us kind of really thank UPI for getting all these retailers onto this mobile devices and making them mobile savvy, and now all of them kind of have mobile devices. We can have the Google Pay or Phone Pays of the world, right, and kind of use them. So that has helped in two ways. One, actually they have made these segment mobile savvy, and hence you can kind of bring them into a digital fold. And second is that the lot of their cash transactions are now flowing through banking channels, and that in a way gives you a good view of their business, right, which was earlier not possible. So earlier in this segment, the basic model is a brick and mortar model. A lot of good companies in that model have done really well. They have put in branches in each location. And they kind of address a parameter of, let's say, around 20 kilometer radius around it. And basically the traditional model was to go to the shop and retailer shop, assess his income, right, by looking at his stock inside the shop, by looking at his bills, looking at how much cash he has in his drawers there, in his till. So those are the kind of basic things. Now with all this UPI coming in, our digital lending pieces are becoming easier, and hence we feel that there are alternate, these kind of data sets are available for us to kind of look at and kind of then project them to get into a projected, to have an assessed income model, right, which kind of has replaced the traditional model of going there and checking his cash and how much cash he has and all that. So that is where I feel a big difference has been made, and that is where the opportunity is immense. Challenges remain everywhere. Challenges, as I keep saying, are becoming better and are becoming better, easier and easier to handle. Right. Another thing would be in terms of documentation, right? So there's a lot of documentation which earlier was physical and again requires a lot of physical kind of access to the customer, and again building up the cost. That again we have kind of technology like I would say click and wrap agreements, e-sign, or sign through OTP, right? So all these basically things have again brought down even the cost of documentation to quite a substantial lesser amount, and that is again helping in terms of reducing the challenge and creating a bigger opportunity for us. So these are the I would just lay down the basic things, right, which are there, and kind of in the way the technology and digital lending actually is kind of helping us to bring opportunities where the challenges and make these challenges lesser and lesser, and create more and more opportunities. Another thing is that what happens in this segment is if you really have to lend at a very big level, you have to also look at alternate data sources. So what we did actually was that we, because there are a lot of customers who do not have a bureau history, there are a lot of these new line customers, a lot of these MSMEs tend to be very young, right, with very little or even no history of receiving finance. So that is where, the supply chain finance, which is what traditionally supply chain finance of SMEs which is now invoice financing, that became the first kind of a thing to be given to a customer, right? And where we basically approach, so where you have an anchor-led closed user group line of credit given to a customer, to these retailers who are purchasing from big B2B wholesalers or from corporates, and kind of give them a line of credit based on which they do their purchases from these customers, from these wholesalers. And that gives you a good so that you're able to fund them based on that data, because that's very relevant data, that the third-party data that you have. And again, the money, the lending that you're doing is monitored, because it's going towards purchase of goods to be sold by the retailer. So that is where, that becomes the first piece to kind of go to the customer and kind of address it. So that kind of has opened up a huge customer base, because you can kind of even go for NTC customers, new to trade customers, you can go and give this product to. And based on that, then once he's serviced that loan for a couple of months and basis that data, you can kind of venture into giving him more and more term loan products, right? And unsecured business loan products. So that is my I'm just laying down a simple kind of what we've done and how we've seen. I'm seeing the opportunities and challenges in this sector, right? Like one data point that I read actually was that only 16% of MSMEs in India have access to organized finance. So that itself is a huge opportunity, right? And that is where we are kind of trying to address that. And there are a lot of good companies in this segment that are coming in and addressing this segment. And that's a very good thing for the whole ecosystem, because the more and more companies coming into the segment will bring a lot more innovation, will bring in a lot more financial literacy or a digital financial literacy for these customers who would be aware, because a lot of these customers are not even aware that there is this lending opportunity available, or there's of their digital financial services available, that are their options that are available to him. And they tend to go to traditional money lenders and borrow from there. So more and more players coming into this field are more than welcome, and kind of help us kind of create a lot more financial literacy around digital financial services being available for these customer base, and that kind of takes India forward, takes everybody forward. So that's my thing.
Thank you so much for sharing your views, sir. And I think you rightly highlighted the challenges both around onboarding, around due diligence. But I think net what I'm hearing is the story is very, very positive. I think essentially what you're saying is India is moving away from an informal economy to a formal economy, with the digitization of data, with access to e-sign, to alternate data sets. All of that will make sure that we can move forward towards more financial inclusion and greater digital literacy. Thank you so much for sharing your views, sir.
Thank you.
Really appreciate that. I would next like to invite Mr. 𝗗𝗵𝗹𝗶𝗶𝗀. Mr. 𝗗𝗵𝗹𝗶𝗶𝗀 heads the product and portfolio management and strategic alliances for supply chain finance at 𝗖𝗵𝗹𝗶𝗀. He has about 16 years of rich experience in the entire ecosystem of SME and mid-market lending. Prior to the present assignment at 𝗖𝗵𝗹𝗶𝗀, he worked at Canara Bank, Axis Bank, ING Vysya, and DCB Bank in various roles. Please go ahead, sir.
Hi, Praveen. Thanks a lot. And thanks all the organizers for giving me an opportunity to be a part of this valuable discussion. Topic is pretty huge. And, this is Chileans on a day-to-day basis. We always keep on discussing, and, a lot of tech thoughts and innovations comes in our daily life. If on a daily basis, if I score my schedule of a day, at least I would say 30-40% times goes in thinking ways how we can improve on this digital lending piece. So if I say that I spend disposable time and energy in thinking about doing some way better than what today we are doing in terms of this digital lending space, that means there has to be a huge opportunity. Though digital lending, I would say, is just that in Indian context, it's a very nascent stage. It's at a very nascent stage. Having said that, though I do not have a recent figures, but based on a published document of RBI, in an overall banking disbursement, only 3% contributed from digital lending. Rest 98% was normal disbursements. And in case of NBFCs, it was around 12%. So When I say about banking disbursement, it's lakhs of crores, and NBFC combined, it's lakhs and lakhs of crores. So 3% and 11%, we have in scope at least to go to at least 10%, 15% if in overall banking sizes of disbursement. And in case of NBFCs, if we bring it to around say 20%, 30%, it's a huge, probably 3 or 4 times or maybe 10 times of what all ecosystems is working. So it is so huge. Having said that, one thing that comes is this, that being an NBFC or being a bank, are we standalone enough to serve to this digital space? In my view, it is not probably. And there where the role of the aggregators comes in. One of the point highlighted during the discussion was that is aggregators around new banks, are they challenges to banks and NBFCs? In my view, absolutely not. They are actually hand-in-hand partners in overall developing the whole ecosystem. As rightly said by Rajat, I am also speaking everything based on my experience that is in SMEs, covering all sort of, even with small business organizations to kind of a mid-sized kind of an organizations, because we cater to all this segment, is the cost of acquisition of an SME customer is too huge. Even if we, these are, and they are not spread only in cities, they are spread all across India. If you rightly cater to a specific city, you will find sufficient business to cater to them, just focusing on a single city. So it is so huge. But then again, if I want to cater to those, I or a bank probably will not be in a position to do, because the cost of acquisition, cost of serving them, the operating cost is so high that it will not probably fit to it. So by engaging with aggregators, we take the advantage of their spread. They are doing quite a lot in terms of their digital journey in our overall SME lending. So we take advantage of it to cater to different markets, which probably we are not in a position to do. Secondly, when I speak about smaller size SMEs in India, they are still family-driven businesses. Lot of hesitance to come into the digital platform in terms of sharing of documents, with signing documents in digital form. So actually, to bring in those segments, we need to engage with them. We need to counsel them. We need to make an awareness about what digital journey is all about. Being a bank and NBFC, probably catering to a specific segment with a limited resources, probably we still not be doing a great justice in at least educating our potential customers. Aggregators has a huge role to play, helping those to come into this thing. That will definitely grow the market. Thirdly, if you ask me, any bank, any NBFCs which has not built in their infrastructure, specifically looking into the digital lending and concern, they will be always having a constraint in terms of how to do a absolute digital journey. It's not that easy journey altogether, because you have a already existing system. You need to extend those to a new system. So a easier and a better route and a very effective route is that do tie up with aggregators. They have capabilities to make your digital journey smoother and integrate them to a pre-decided stage where you think that this is the point that we can integrate and handle things within our system. So hold this journey. I think for an NBFC in this thing, aggregators are playing an extremely essential role. They are guiding us in many ways. That have been my experience. I'm sure that other panelists also shall agree to this point. Now, speaking to a bit of a darker side of it, the challenges. What are the challenges that comes to our life? Definitely, challenges are multifold. Probably it itself can be a session to be discussed for hours and hours. But then again, let me break it in very 2-3 small parts that I think are playing a critical role. Is just that one is the regulatory challenges. I've not said that RBI is creating a challenge to us, but then again, the whole ecosystem of lending that has been built is not built considering the digital lending as the most important priority of it. So just that we are trying to match in the digital lending into the existing systems. Though many cases it seems that we are completing a digital journey. But in reality, if we see, for me, I would say I am doing a complete digital journey only when I am giving an experience to my customers, the great journey of digital listing, his hassle-free engagement, being a borrower with us, his limited engagement to borrow money. But are we actually in a position to give it? Probably no. And that is probably leveraged only when enterprise 𝗖𝗵𝗹𝗶 becomes more huge in terms of database like customer 𝗖𝗵𝗹𝗶s. That is the only way that, of course, last year RBI had made it mandatory for all the NBFCs to create a database and a repositories, but that repository is not yet very strong. So that we can rely upon and straight away take a number for this thing and do it. In absence of that, the other routes that we follow, of course, it has a part of digital in it, but then again, a lot of engagement with the customers. Example, video KYC. If you want to do it, if there are a couple of guarantors involved in it, you'll have to engage with each and every one of them. Not necessarily all of them will be sitting in the same place. So it has, say, 5 guarantors. You have to engage for 5 times, once for a company. So, of course, it is reducing this thing, but then again, full experience for a customer perspective can happen only when this kind of, repositories are good enough to support a whole digital journey. And probably it will take around 5-6 years to have this kind of a database with us so that we can use it. Next, a constraining point, most of the lending, we take NAS. So there is no ENAS for any SMEs. We cannot take it. Whatever you call it, eventually, it is you'll have to send a pre-fill, maybe ENAS form to the customer. Look at the customer's point of view. They will anyways have to download it. They'll have to take a printout of it. Have to, if not pre-fill, they'll have to fill it, have to sign it, and again, scan it, then have to send it. Physical movement have been reduced, but in absence of ENAS facilities for SMEs, the experience to a customer cannot be fully digital. So, though there are so many others, then yeah, considering the time constraints, let me end my thing in terms of regulator to this. Second challenge, Rajiv had already pointed, is the awareness and awakening of the borrowers. If you are ready even to give them a full digital experience, they will be hesitant. They will be hesitant even to share at times in digital platform, they'll be hesitant even to share their pen. One of the experiences recently I had is one of the customers said, I'll give you everything apart from pen, because I doubt that by giving a pen, you'll be retrieving everything, including my ITRs and everything. I don't know why I need to give it to this. So this becomes a challenge for us to make those customers understand that whatever we are trying to do is nothing different from a physical movement, but you accept it. It will eventually make your life better. So this is again comes as a challenge. Third, that is, we always face it. Everybody faces it, is that our internal credit policies. We as an organization had not made a credit policy keeping digital lending as the only way of lending. So it has both, right? Because we cannot do it that if until it's 100% digital, then we cannot make it a policy. And if a policy that is made for a normal brick-and-mortar model, will it fit for a digital lending? Probably not. And a policy made for digital lending, will it fit for a brick-and-mortar model? It will not. So there is a need always overall to have a kind of a hybrid kind of a credit policy which will suit both the needs together. And that's not a very easy thing to do, because it is not about making a policy. You'll have to educate those who are using this policy for the mitigation of risks and underwriting your credit risks, actually. And that's, success of your organization as a lender is based on how effective you are in seeing the, risk factors that are involved in it. So these are all, in small words, these are all challenges that normally in daily life that we keep facing. Lastly, there's a point that is just that, with this digital lending coming in, are our presence of branches in different locations coming redundant? In my view, it is not. because the lending journey of a borrower goes through, in layman words, we see that, somebody has applied and he has got the loan. In reality, it is not that. He goes through phases and phases before actually he gets the loan, and after that also he keeps engaging with it. It has discovery phases wherein we find a customer from the market, the right set of customers that are profitable for them, as well as a mutual profitable relationship can be built in. Then it is document collection process, underwriting process, then document signing processes. Once it has been signed, the disbursement process comes in. It's do not end at the stage of disbursement. 3 critical stages still remain. One is you need to collect the money that you have given in a market. You need to monitor the portfolio, where it is going, what is wrong at an early stage. And third is that you continuously have to keep serving your customers. And it's more relevant in case of a revolving product. In a term loan kind of a product, once you engage with them, probably for 2 years, 3 years, there's only the collection part of it and the money coming back. But then again, for a revolving product, you have to always keep on engaging with customers. And consider a scenario wherein we are catering to SMEs, which is a kind of an ocean. There are so many segments, there are so many industries, so many business models. Every business model is unique from somebody else. So, and there are a lot of micro and macroeconomics involved in it. At times, I have seen cases wherein cluster of borrowers going bad together. It's because of some locational effect that have happened, which is not prominent, not seen in any part of India. To have a right-hand experience on this, and in present context, how do we do it? We need to have a presence in that particular location. Then only you can do it. And say, for example, one customer goes, not bad, but yeah, payments not coming regularly. Straight away going, with a revolver, with a recovery process would not be advisable for SME settlement customer, because they faces lot many challenges in regular delivering their businesses. Engaging with them to understand the root cause, maybe just an understanding of the root cause can give us a very easy solution. Instead of going on this thing, we can bring them back to track. It's a business for us, right? And also a potential customer for us, and a word of mouth. All 3 things are involved together. So these points can be catered only when we have a team that is local. It cannot be, I'm sitting in Delhi, or maybe one of my peers sitting in Bombay cannot cater and deliver those kind of services in Kochi, right? He might not be knowing what exactly is happening there. Remote locations, geographic specific problems. So we need that. Still, I still believe that, until and unless we develop an kind of an AI-based model or a machine learning, for that also we need to have a systematic process of collection of data for years and years. Then only we'll have to develop a model, right, to a reliable and more stable model. So till that time, there's always a need to have this thing, if not at least a spread across branches. But then again, regional presence is something that, in my view, in present context, is essentially required. So these are all small points that I wanted to cover from my experience and what I have been seeing and handling.
Thank you. Thank you so much for sharing your views, sir. And I think all practical challenges that you've very rightly highlighted. I mean, areas like the absence of e-NACH for SMEs, credit policies, different credit policies for the digital medium versus the physical medium, what you were talking on the collections, all the need for, again, digital literacy that came out very strongly from your views, with SMEs being family businesses, and therefore their hesitation and their challenges on fraud risk in sharing documentation. I think very, very significant points, sir. Thank you so much for sharing your views, sir. I'd now like to invite Mr. 𝗖𝗵𝗶𝗶𝗀𝗶. He's the CTO and co-founder at 𝗖𝗵𝗽𝗶𝗶𝗀. He's directly involved in all technology-related aspects of the business and organization. He graduated from National University of Singapore and has been in the technology domain at leadership positions through 2 decades of experience. Please go ahead, Mr. 𝗖𝗵𝗶𝗶𝗀𝗶.
Yeah, thank you, Mr. Praveen. A very good afternoon to fellow panelists and fellow participants in this webinar. I think Mr. Rajat and Mr. 𝗵𝗴𝗶𝗶𝗀𝗶, right? So they have raised proper, valid reasons and proper opportunities and the situational aspect, what is happening in the current fintech, right? So as both of them mentioned, there is a massive opportunity here, right? As in the sense that since there is very less digitization of the whole lending aspect, is the very fact that the fintechs are basically now present in this whole ecosystem, right? So when 𝗟𝗏𝗶𝗴𝗶𝗀 started off in 2018, we started with basically the goal of making, giving the customers, right, providing the customers loans at basically with the fastest way in the least frictionless way, right, with the least friction. So, so we did face a lot of basically, as all of you may highlighted, right? There were a lot of a lot of basically obstacles in this whole process, right? And India is actually going through what I would say is basically a digitization journey, right? As in it has started probably a few years back, right? Almost half a decade back, and the journey is still basically going on, right? As in it's not a smooth journey. As in we had, let's say, if you take a look at some of the notable incidents, is what I would say. I think one of the biggest incidents would be that the removal of 𝗖𝗵𝗹𝗶𝗶𝗀𝗶 access for most of the basically NBFCs and other some of the services which we were using 𝗖𝗵𝗹𝗶𝗶s, right? And then demonetization came, which did help the digitization aspect, but it still basically was a whole kink in the whole process what happened, right? And past that, actually, even RBI the regulators are also learning what is happening in the system, and they are making certain tweaks, which obviously is hindrances to basically the entire journey as what we're going through. But as I said, because of the whole wide aspect of whatever it is there, the opportunities are there, right? So at 𝗟𝗏𝗶𝗴𝗶, what we do is that we provide basically digital services to pretty much all customers across India, right? So, I would say that basically we segment the customers into different, mainly 3 different segments. One is basically as salaried people, right, where we have a certain set of basically products that we can offer, right? And we have basically self-employed as basically maybe even some of the SMEs, the small kirana shop owners, etc., who are self-employed is what we would categorize, right? They get a different segment of loans. And obviously there is a large unbanked sector in India, right, which is what the new to credit segment of people are, right? As in if you look at the credit lines that are available in India, it's very, very less compared to the entire amount of people who are basically transacting throughout across India now with UPI and all these other digital means, right? So these all customers are, they have credit, but they are new to credit as in the digital space, right? So that's why we call them NTC kind of customers, right? So we treat them as a different set of this thing to build the systems up. And on top of this, what we have found is that as an we need, the idea is that once you start giving these services, what we have done is we built a layer upon that where we give them some more adjacency services, something like more like basically insurances, right? As in more tuned towards the segment of customers that we are looking at, right? As in you could say basically 1 lakh worth of insurance or 10 lakh worth of insurances, which makes a difference basically to a lot of people in India who are not insured, right? As in 10 lakhs makes a lot of difference to majority of the customers in India, and they are uninsured, right? As in, so it's basically a big eye opener for that, right? So with all these things and with the journey through what we have been through, we do have a massive amount of volume in terms of number of loans that we provide to the customers and number of adjacency services that we provide to the customers, right? So given this, basically what happens is that, right, without technology, this is not possible, right? As in the sense that as some of these things were saying, the banks are there, but then if you imagine a person in a tier 3 city basically trying to getting a loan, right? He would not get a loan without bare minimum 2 or 3 journeys to the bank, which would be probably 10 kilometers away from his hometown, right? And that's a to and fro basically experience. The customer is basically more at the mercy of the bank to basically get the loan, right? So we, with the digital space, what we're doing is that we are basically, the whole thing gets contracted, right? As in, you bring basically the bank to the doorstep via the mobile services, whatever is there available, right? So when these things happen, you have to have these AI and ML models available, right? As some of the members were saying. And what we do that is that we segment that again into probably 3 different areas, right? One is basically the knowledge or experience based models, right? In the sense that this is the experience that let's say you've derived out of the number of years in the industry. Let's say, for example, we take a farmer. He says that, okay, based on my experience, this is what I need to sow at this point in time to basically get a good crop. And that does work to some extent, right? So that forms the base layer. And then on top of that is the database basically decisioning that we do, right? As in, since we have now run through a lot of data, this is more like akin to, let's say, doing the satellite-based mapping of the agri world, and then giving more input to the customer that, hey, as in, I think probably you solve this, you'll get more rewards, right? As in, so the same kind of basically the feedback into our own system is what we do, right? In the sense that based on the data, right, as in we can upgrade the customer into a certain level, right, as in based, and give them a bigger line of credit. See, the customers finally are looking for maximum credit, and we are looking for basically giving the same credit at the least risk, right? That's the whole idea. As long as the credit is with me, as in there's zero risk, right? As in, all of us understand that. And the point is that how do I give it to the customer so that I also know that he's risky? And all this is happening, without us meeting face to face, right? So that is there, right? And the third thing is where the whole crux of the whole AI and ML thing comes in, is where the models itself start tweaking themselves, right? Based on the based on the data. This is where basically some certain impacts or certain market related events, like maybe COVID is an outlier, but you could look at maybe some of the other events which you have gone through in the recent history, like the NBFC tightening, liquidity issues, and all those things, which is where the models can start self-regulating to a certain extent, right? As in, you cannot let them run free also, but you need to have a certain amount of regulatory as an overview over that, right? So this is the way that we do. So at least in Credit-B, what we do is that we are pretty much digital oriented, right? 100%, let's say not 100%, 98, 99% digital oriented, right? And all our customers run through the same models. And this is where the physical aspect, I think somebody also was mentioning, that comes in, right? As in, so we do have, let's say, a certain small segment of people who are in the offline sales is what we call, right? As in, that is there. And here what they do is that they are only in the aspect of basically not in the verification or anything like that. They're only enablers in the verification aspect, right? So that some of the fraud and other things that happens generally when there is a physical touch point can be eliminated, right? As these are some of the things that we take care. And with respect to basically, this is with respect to I speak more on the technology aspect because I'm the CTO there, right? So with respect to the AI and ML side, this is how we kind of run it. And we also, what we do is that we kind of generate a digital persona of each customer, right? As in the sense that, so it could be like, let's say, a very simple aspect that like number of bank accounts that you have, or what is the average balance that has been there in the bank account, kind of things, right? This is just some examples, but we do have a vast portfolio of the basically digital variables, which generally it's like, your shoulders are 42 inches and probably as in your basic whatever dress size you buy, right? As in that's like your physical persona, right? Like that we have a digital persona which we generate, and based on which is where all these AI and ML models run, right? As in, so when we do this, obviously the aspect is that what about basically the things, the people who fall, the outliers, right? Who don't fall into this kind of things. This is where we have cutoffs, actually, right? As in the sense that if the models the models run, and then there are certain cutoffs, and which is where we have a small segment of people who are in the physical, who do the process the profiles manually, right? So I would say that around 80 to 90% of them are automated, but then there is still some 10 or 20% of them which should go through basically a manual process of vetting to make sure that what the systems are feeling that maybe not right, or what we feel is not yet mature enough to basically be deployed or put into the actual production systems, right? Get into the manual aspect, right? So this is where these two things come in. And with respect to, since we do all these data points, there is always a question about the trust aspect, right? When we say this digital person and all those things, the idea is that what are you doing with the data, right? As in stuff like that, right? Obviously, India is unique in a way that we have a strong regulatory body here, right? So if you, this was a paper, there was a paper which I read long time back in the late 90s when I was a college student. So it is called no U-turn syndrome, right? If in a U-turn, there are some countries where you have a U-turn, and just to explain briefly, as in where you have a U-turn and there is no signboard, people will not take a U-turn. They'll not do anything. They'll just continue, right? And in some countries, they only follow what the symbols are there. So India is both a mix of both of them, in the sense that in the regulatory aspect, at least in the financial world, we follow certain guidelines, in the sense that when there is a gap, we do try to see what are the signboards, etc. there, and then try to follow it. Though we do slightly try to innovate on it, but that is where mainly we have a strong regulatory body with that. So this has actually helped mainly with respect to keeping the customer in mind, right? Which is obviously what we also have in mind. So we give the utmost importance to the data, what is collected, and how the data is processed, and how the data is basically massaged to come up with basically the digital person of the customer, right? And we do comply with all the policies. And to do this, what happens is that, since there are multiple avenues of the delivery mechanism, right? We need to be, again, Google Play Store is there where you need to again comply with that, and so on and so forth. So the customer also needs to, like, let's say when he gets a 500 rupee note, in the villages, if you give, he'll first feel the note to see whether it is basically a fake note or a real note, right? So the same thing needs to be done in the digital world also, right? When you download an app, you don't just blindly download an app based on the ad that comes, right? You probably need to look into a bit more, which is where we come in, and then 𝗖𝗵𝗹𝗶𝗴 as this thing, we do follow the best practices, in the sense that we upfront say that what are the lenders that are there. I think InCred is also one of the lending partners on our platform, right? And we do have a long list of basically platforms, lenders who are there in the platform. So the idea is that education of the customer with respect to what is it that we are going to doing with the data, and how is it that we are doing it, where, why, how, and these some questions are answered to the customer to bring in more awareness to the customer, right? So the idea is that you don't sign on anything, any white page of document, right? And similarly, when we click on that, I accept, the digital equivalent of basically signing on a white sheet of paper or something, we need to basically educate them more to basically understand what exactly it is there, right? So there are a lot of aspects there, looking at the privacy policy, looking at the authenticity of the website, basically whether there is a proper headquarters which is there of the office, basically what are the data protection guidelines which is being followed as per RBI and maybe as per even Google Play Store that is there. What is the loan recovery process, whether they have really mentioned, whether there's a grievance officer actually assigned, etc., and all those things, right? So there are a lot of these things which are there, but unfortunately, some of the customers don't see that, right? But the idea is that as this thing is becoming more and more relevant, some more customers are basically looking at it and getting into the system, right? So that is actually very much of the need, right? In terms of, again, coming back to the physical aspect, whether we are basically a challenge to the bank or whether we are a threat to the banks, I would say that it's more of a symbiotic relationship, right? In the sense that the opportunities are there and the banks are not able to tap into the opportunities, mainly because of the very aspect of how the very nature of how they basically are in the business of performing, right? And it's the opportunities are there. Because the opportunities are there, we can also basically start providing additional services to the customers, both sides, right? As in the B2B side as the banks, and in the B2C side as the customers. And definitely you can form in a bridge as a part of the whole aspect, right? As in that is there. And as a part of the trust factor, also what we see, at least in our side, is that we envision basically getting into opening some physical, maybe a physical branches, but more in terms of brand branches, right? Is in the sense that it's a phygital world, is what I would say, right? In the sense that it's a physical setup, but everything is digitized there, right? As in is what I would say, right? There is no paperwork kind of thing there. A physical setup, but fully digital, as in probably to help some of the customers run through the move over from the physical aspect to the digital aspect. That is there, right?
Sure. Thank you so much for sharing your views, sir. I think three very important themes that I'm picking from your message, sir, is one is the digital persona for the customer. I think that's one big area that's really come out. I think the trust factor, building that trust between borrowers and the digital lending app. How does one do that? And I think the need for both the digital and the physical to coexist. I think the phygital model, that will be the model for the future from an Indian standpoint. Thank you so much for sharing your views, Mr. 𝗖𝗵𝗃𝗴𝗶. Really appreciate that. I'd now like to invite Mr. Amit Lodha. He has more than 20 years of experience in investment banking, corporate finance, and investing. He has been associated with Kotak Group and KKR during his last and during his last stint at HDFC. He was the national head for the debt capital markets business at the bank. He's now a founding member and CEO of 𝗖𝗵𝗃𝗴𝗶.
Thank you, Praveen, and thank you for all the patient hearing that you guys. I think most of the challenges have been covered, from Rajat, Karthikeyan, and 𝗖𝗵𝗹𝗶𝗴 in terms of what exactly the financial lending space. What I'll do is I'll take a moment to talk about 𝗖𝗵𝗃𝗴𝗏, and probably I'll talk about a larger issue, a macro issue in terms of whether fintechs are on an uneven space vis-a-vis bank. I think Karthikeyan briefly touched upon that. So basically, 𝗖𝗵𝗃𝗏𝗏 is the employee wellness initiative that over 1 million customers have adopted today. Basically, we try to provide a bridge to salary to underserved and underbanked customers through the corporate route. And the idea is to basically, if you look at people who are earning less than 40,000 rupees, that is real India. They run out of money by third week of every month, and that is where we actually come in and help them. So actually, the point I would like to address here is whether are fintechs right now being treated unfairly, or I would say, or banks have been given more precedence, or because banks are thinking that fintechs are creating a threat to them. I don't think so. I basically believe that fintechs or digital banks are complements to traditional or modern banking fraternity. Basically, fintechs are catering to people who are underbanked and unbanked today, right? That is the focus area for us, And 58% of the working population of India, and that is a large number. I would say ideally this is the organized sector for India, rather than vice versa. So if you have 58% who are unorganized, actually that is the organized sector for India, is in my opinion. And that is the real India, and basically which fintechs are actually catering to. And that is basically a complement to banks, because banks don't see them as customers who can provide them, I would say, a lifetime relationship value. The cost of acquisition is very high, and underwriting, monitoring, collections very high, and they have a physical model predominantly, And if you look at historically, we had cooperative banks, rural regional banks, or local area banks who were basically meant or established to meet the needs of these people that we had tried to cover. But there were a lot of challenges in those banks, which I'm not getting to right now. And that is where the fintech has evolved in the last 4 or 5 years, I would say. And the one more important thing I would like to bring to attention is, if you look at India, India is, in spite of having the best of the banks and financial institutions, is a great start country, And hence there is so much of influx of working foreign capital in the lending space. If you look at Kotak or HDFC or ICICI, there are foreign-owned banks. They are MNCs. 76% is held by foreigners, right? If we have fintech companies or digital companies in India and we're getting money from outside, why can't our banks or our financial institutions look at collaborating with them, investing with them, and creating an extension in terms of what fintechs are doing, rather than competing with them. And that is where we lack. So much of retail savings in India is there, so much of low-cost funds are there. But having said that, we are relying on foreign capital to do this, and the economics are also going out of India because of this. And that is a bigger challenge, I would say, fintechs are facing, apart from the operational challenges that we pointed out. So this is basically my 2 bits on, the digital challenge on a macro level. In terms of technology, obviously, fintechs are far ahead from banks. Either if you take Kotak or HDFC or private banks who are spending thousands of crores, I would say nowadays in building up tech and trying to get there. But having said that, they're again focusing on customers which have a lifetime relationship value for them, not people who are actually fintechs are trying to serve. And Karthik is serving people who are looking at people who are NTCs, right? There is an alternative credit model which Rajat is building up, and that is what we are also working on. And largely, I think fintechs are doing that in some sense of form, and that is the way the financial inclusion will happen. And in terms of getting people to get into CIBIL score, if they're taking loans from fintech companies, reporting it to them, so they're enabled to take 2-wheeler, 4-wheeler housing loans from banking for me tomorrow. Today they're not eligible to do that. Obviously, technology is a very, very big, I would say, enabler. And at Fatakti, basically, we rely increasingly on AI and ML to add value in 5 main areas in the customer journey. One is customer acquisition, credit decisioning, monitoring and collection, deepening relationship, and trying to do smart decisioning or servicing to the customer. We profile the customer, and we want to live through the customer journey of the customer or through his life cycle. So these are the 2 or 3 bits I would like to say, because I think challenges have been covered pretty well by previous speakers.
Thank you. Thank you so much, Amit, for sharing your views. And I think very, very common themes between your message and the messages that we've heard earlier as well. I think the common message that's coming across is fintechs are not challengers to banks. Fintechs are essentially partners to banks, and both have to coexist and really work together in order to build financial inclusion from an India standpoint. So thank you so much for sharing your views, sir. I'd now like to invite Vikash. Vikash has worked on internationally reputed projects like the $10 billion merger of FM with AIG Insurance. He's an erstwhile banker from Citibank, an internationally known strategy specialist. Vikash, it's over to you.
Yeah, so hope I'm audible.
Yes, please go ahead.
So good evening, everyone. First of all, thank you, 𝗗𝗵, Praveen, and the entire team for inviting me for today's panel discussion. My warm greeting to all the other fellow panelists for laying the context as to why digital lending is important, the opportunities and the challenges as well. Now, from a professional standpoint, I will take a slightly different stand. While we have heard the industry point of view so far, I'll try and present a point of view from the consumers, the people who are trying to benefit from this entire ecosystem of digital lending. And I will also try and give my views about the recent RBI's paper, the challenges that have been positioned, the recent circular, which is being called the winter of digital lending, and happy to take questions, if any, that come forth. Now, before we go forward, we need to understand from a consumer's point of view as to why is there a sudden buzz around fintech. The entire industry as such didn't exist about 8-10 years back. From an Indian diaspora point of view, if you look at the MSME segment, which today employs more than 110 million Indians across close to 60 million companies, accounting for about 30% of GDP, 40% of all lending that happens in the MSME segment even today comes from informal channels. And even the access to credit that MSMEs have in our country is not the gold standard, or not what a larger corporation has easily available to its credit. So this is one clear sector where more and more fintech initiatives and where more and more digital lending initiatives are gravitating to. Secondly, if you look at the entire Indian banking space, even today, close to 100 million Indians don't have bank accounts. That gives enough and more headroom. And when people don't have formal bank accounts, they rely on informal channels for their lending requirements. And one of the key initiatives when we go around and talk to more and more fintech and digital lending startups is that they're trying to reduce cost using technology, which a traditional banker ideally will not be intrigued towards. Because any loan which is below about lakh rupee in its size entails the basic processing charge, which can vary anywhere between 2.5 to 5,000 rupees, thereby reducing their overall loan portfolio profitability. And this is where digital lending startups across the globe, not just in India, have an edge over the traditional banks in terms of using technology, reduce cost, increase their access to both bank and in Indian diaspora, the unbanked segment of the economy, and ensure lending has the last mile connectivity. Now, in terms of the organized sector as well, we today have more than 120 million youth who are employed in India and have no credit cards. If you look at the debt to GDP ratio, India stands at 56%, vis-a-vis 135% of our peers within the Southeast Asian economies and even in Asian economies. China, for instance, currently is at about 160% ratio. And coupled all this with the additional edge that digital lending startups have, for instance, looking at linking the loan repayments to business cycles. Now, for a traditional lender, the repayments are fixed, come what may. But one bad quarter in the life of an MSME company can not only spoil their ability to repay those loans at that particular quarter, but because of the credit cycles, also reduces its future lending capabilities. Most digital lending startups not only provide the ability to link your repayments to your business cycle, but they also provide other differentiators such as giving flexibility in the repayments, having faster turnaround times, ability to borrow multiple times, and also use digital data to ensure that credit profiling, the customer profiling is done better. If you look at the present status of digital lending in the country today, my data can be slightly dated, but on an average, but overall basis, the message that I'm trying to convey is as follows. Indian lending market today is close to about $1.73 trillion, roughly about 130 lakh crore, of which the individual lending accounts for roughly $800 billion. Now, compare that to digital lending to individual, and it roughly boils down to about 40-50,000 crores in dispersal, which is roughly about $8 to $10 billion, depending on how digital lending is truly defined. And I will come to that also in a minute or two when we look at the RBI's report and the things which popped out for me in that report and in the recent circular as well. Now, broadly, the RBI's digital lending report has taken a very balanced view, calling for specific regulatory interventions to reduce both concentration risk and eliminating the regulatory arbitrage. And the report also highlights the neobanking and decentralized finance industries. Now, so net-net, the idea here is to ensure that the regulators weed out the unscrupulous practices, the frauds as we call them, while maintaining the growth and momentum for the regulated and organized players within the digital lending space. The key areas of challenges that were clearly highlighted in the report, which are being talked about in multiple forums across the country, few of which have already got enlisted in the recent circulars, and the rest which might get enacted in times to come, can be defined in broad 8 categories. Number one, there has been a clear distinction between the balance sheet lenders and the loan service providers, where clearly the loan service providers are now being discouraged from lending directly. We are talking about a ban on the FLDG. While it was touched upon by my fellow panelists, the first loss default guarantee providers, the synthetic bridge as it is being called now, that gives a backdoor entry to a lot of people to do a run on NBFC, a run on balance sheet, which makes it difficult in the larger play by increasing the concentration risk. So when we talk about challenges, this is one area which is being clearly addressed by the regulators. Thirdly, the report calls for elimination of regulatory arbitrage. Think of it this way. Today, almost every app in the market provides some form of the lending or the other, whether it's e-commerce, the food delivery, the cab aggregators. Further, these loans are available in a matter of 3 clicks. There is no insistence on KYC or the background check of a particular borrower. Well, the positive is that this has led to multifold increase in penetration of the lending in the country. The flip side are the arbitrage which is being created, whereby the key challenges amount to over leveraging of the customers, the usurious rates that are being charged, at times the collection methodology being deployed. And this is something which is being clearly addressed. And in the long run, once the system cleans up and clear guidelines are set with regards to the regulatory arbitrage, the system would only be set for higher momentum and faster growth from here on. RBI is also clear in terms of calling for the APRs, which is annual percentage rate transparency, calling about 40 to 50% charge on a particular lending transaction has become very normal in the industry today. Now, most of this is not packaged as interest rate, but rather as varying level of charges, right, from processing to other formats of charges, whereby the interest rates on face of it looks quite palatable. But as per the recent report, RBI would like for this to be transparent. This is similar to what happened to MFI industry a couple of years back, whereby all rates had to be made transparent, and so that customers, the end borrowers, can take a more informed decision. Fifthly, RBI also calls for fair treatment of all the borrowers, especially in the event of unfortunate defaults, so that unscrupulous means in terms of loan recovery can be avoided and more data can be deployed in terms of predicting possibilities of default in future and also employing better formats of recovering the same. RBI also calls into question the loan being given under formats like BNPL, where it says that all forms of credit which are being given to a customer be defined as a credit. In simple, call spade a spade. And this might spell woes for a lot of companies who are existingly playing under the BNPL category in the country. While it is a challenge, but if rightly addressed, this can also be turned into a sizable opportunity as far as the industry is concerned. Net, both looking at the industrial diaspora and also RBI's direction, two things stand out very, very clearly. One, both the industry and the regulators are interested in what is calling the financial inclusion. And as we march towards higher financial inclusion, taking into account the 190 odd million unbanked citizens in the country who are relying on informal channels, taking into account the 120 plus million employed youth who still don't have access to a credit card, taking into account the 40% plus lending, which is going directly to MSME segment in the country, again via informal channels, increasing the cost of their funding and thereby making them uncompetitive or non-competitive when compared to their global counterparts in countries like a Taiwan, or a Vietnam. If some of these woes can be addressed using technology and using the digital lending initiatives, it will strengthen the industry and thereby lead to a more stronger economy. So those are some of my views. So Praveen, back to you.
Thank you. Thank you so much for sharing some of those important views, Vikash. Really, really appreciate that. I know I'm conscious of time. I think we can go on and discussing about this deep subject. Several challenges have been highlighted today, right from onboarding to due diligence, underwriting, to collections, to digital financial literacy or the lack of it in borrowers, especially on the SME side. So several important themes that have been covered. I think the net broad view that I'm sensing is the story is positive. The story is digital going forward. And the move certainly for India is from an informal sector towards a more formalized sector. And especially with the use of mobile, API, with account aggregator coming into picture, with a lot of alternative data sets, with e-sign also coming into picture. I think net the story for India is very, very positive. and there's much more to be done on the financial inclusion side. Happy to hear any closing thoughts. Rajat, any closing views from your perspective?
I think everything got covered, and everybody, Vikash really laid all the parameters really well. Amit actually kind of also addressed the banking pieces there. So, I think it's pretty well covered. Karthik was also quite eloquent in telling us all these things that are being taken up. So I think nothing closing. I think net, we are always positive about the economy. India is on the growth path. What we believe is the next decade belongs to India. And that is where I think everything is falling in place. RBI's activism is quite welcome, actually, because they are taking steps to kind of manage this. They understand that there is a huge opportunity, but they're taking steps to kind of regulate it in much better way. There are certain things that sometimes fintechs have done in terms of finding a loophole or kind of finding this thing, but then they've come back on it and kind of clarified and put regulation in place. So it's really welcome. Regulatory growth is always good growth. So I feel, as I said, we are quite positive about the whole ecosystem.
Perfect. Thank you so much, Mr. Karthikeyan. Any closing thoughts from your side?
I think Mr. Praveen and Mr. Rajat, I think both of you have concluded quite well. It'd probably be the same wine in a new bottle, right? If I say the same things. But on the technology aspects, I think only with technology and with the scale at which India is there, and with the diversity of the Indian population, right, which we can bridge the gap of the whole aspect of basically providing financial services to all our customers. And technology needs to improve in certain aspects, right? And with the help of RBI, definitely we can bridge the gap. Some of the small, the gaps which are there, in which basically you can fully digitize the entire journey. With the help of RBI, anyway, the bridging is happening, but they are also basically closing the further, laying more bridges around the gaps that are available, right, as of now. So definitely, I think it's going to be this decade, right, is going to be a phenomenal journey, is what I believe.
Perfect. That's a really, really positive note. Thank you. Amit, any closing thoughts?
I think, like I want, again, this more of a collaborative effort the entire financial industry has to take, and work with each other rather than, create uneven platforms for people. I know there are challenges that has entailed the regulatory body to do that. But having said that, is look at more macro view and what fintechs have achieved in the last 5 years. Look at the kind of scale and size people have achieved. That has to be kept in mind.
Perfect. Thank you so much, everyone, for sharing your views. Really, really appreciate your time. And until next time, it's bye for now. Thank you.
Sure. Bye-bye.
Bye-bye.
Thank you very much. Bye-bye.
Thanks, everybody.
Thank you.